What if I told you that the vast majority of retail traders are playing a game that's stacked against them? It's like showing up to a tank battle with a pea shooter. I know, because I was one of them. I used to think the answer was a better, faster, more secret strategy. But the real gap between a retail trader and a billionaire investor isn't some magic indicator or a faster chart. It's a completely different rulebook. The difference between winning and losing isn't about the tools, it's about your entire approach and the scale you operate on. And in the next few minutes, I'm going to show you how to start thinking with their rulebook. We're going to break down the 3 levels of trading: the retail mindset, the hedge fund process, and the billionaire's paradox. By the end of this, you'll see why the game changes at every level and how you can start applying institutional-level thinking to your trading today, no matter how big or small your account is. Let's start where most of us do: the retail trap. When I first started, my screen looked like a NASA mission control panel that had short-circuited. I had 15 indicators, I was in 5 different signal groups, and I was glued to the 1-minute chart, totally convinced I could outthink and outrun the market. My whole world revolved around one thing: finding the perfect entry. I was obsessed with patterns, breakouts, and what I thought were secret levels. But my account, it was a roller coaster of gut-wrenching losses and quick, thrilling wins that never seemed to add up. This is the classic retail experience. We're taught to react. We see a price breakout, we buy. We see a trend line snap, we sell. We are, essentially, reacting to things that have already happened. The problem is, these reactions are predictable, and in the market, being predictable makes you prey. Large institutions don't just react to the market. Their massive orders create the very waves that retail traders are chasing. They capitalize on the predictable, emotional responses of the crowd. The psychological weight on a retail trader is just immense. Every tick against you feels personal. A losing trade isn't just a data point. It feels like a personal failure. A win brings a rush of euphoria that often leads to overconfidence and a bigger, dumber trade right after. This cycle of fear, greed, FOMO, and revenge trading is where most accounts slowly bleed to death. We treat trading like a high-stakes slot machine instead of a business of managing probabilities. We're so focused on the outcome of a single trade that we forget the only thing that matters in the long run: our process. Most traders lose money not because their strategy is awful, but because they treat trading like a video game instead of the brutal psychological war it really is. You can have a perfect strategy and still get destroyed by your own mind. The biggest mistake is thinking we're playing against the chart. We're not. We're playing against incredibly sophisticated, well-funded institutions that understand retail behavior better than we do. They have a good idea of where we're likely to place our stop losses and what patterns will trigger a flood of buy orders. So, how do you stop playing their game and start playing your own? It all starts with a huge shift in perspective. My turning point wasn't finding a new indicator. It was the soul-crushing realization that my entire approach was wrong. I was a lone wolf making emotional decisions with zero structure. Hedge funds, I learned, don't work like that. They operate like a business, and their success is typically built on 3 pillars: a rigid process, statistical risk management, and a detached psychology. The big secret? The edge isn't just the strategy itself, but in the built around it. First, process. A hedge fund trader doesn't just roll in and start smashing buttons. Their day is structured. Many use checklists for entering trades. They log and review every decision, and they have a playbook for different market conditions. They aren't chasing every little wiggle. They're waiting for specific, high-probability setups that fit their plan. They know that consistency is more valuable than frequency. One of the biggest differentiators is the trade journal. It's not just for tracking P&L. It's for documenting your emotional state, the why behind the trade, and the quality of your execution. This turns trading from a gamble into a skill that you can actually analyze and improve. Second, their approach to risk is on another planet, Solomway. A retail trader might say, "I'll risk $100 on this." A professional trader defines risk as a small, fixed percentage of their total capital. Many firms enforce strict rules, like maximum position sizes and hard daily or weekly loss limits. If a trader hits that limit, they are done. Period. This is what stops a bad day from turning into a catastrophic, career-ending one. They think in terms of expectancy, over hundreds of trades, not the outcome of the next one. This statistical mindset lifts the emotional weight off every single decision. Third, and this is the big one, is psychology. An institutional trader isn't trading with their personal rent money. While their bonus, or even their job, is on the line, the firm is built to absorb losses as a cost of doing business. This creates a psychological buffer. They are trained to be process-focused, not outcome-focused, knowing that if they execute their process correctly, the results will follow over time. It's a shift from being an emotional participant to becoming a cool, detached operator. So how can you start doing this right now? Start treating your trading like a business. Before you take your next trade, write down your exact entry, exit, and stop-loss rules. Define your risk as a strict percentage of your account. And after the trade, journal not just the result, but how well you actually followed your own plan. If this idea of building a professional process is starting to click for you, make sure you subscribe, because we're going to go much deeper into these institutional techniques in future videos. Now, let's go to the final level, the billionaire scale investor. This is where the rulebook gets torn up all over again. The problems at this level are completely flipped upside down. A retail trader's challenge is finding a winning strategy. A hedge fund's challenge is executing that strategy with discipline. But a billionaire's challenge is totally different. How do you even deploy that much capital? This is the billionaire's paradox. When you're managing billions, your biggest enemy is liquidity. Think of it like this. A retail account is a jet ski. It's nimble, can turn on a dime, and can slip in and out of markets without anyone even noticing. A hedge fund is more like a speedboat, still fast, but it makes a bigger wake. A billionaire's portfolio, it's a supertanker. It takes miles to change course, and its sheer size moves the market around it. If a billionaire wants to buy $500 million of a stock, they can't just hit a buy button. An order that huge would cause the price to spike instantly, destroying their own entry point. Their buying pressure becomes their biggest cost. To get around this, they use sophisticated algorithms that break up the order into tiny pieces, or trade in dark pools away from the public eye, slowly building a position without tipping their hand. Because of this, their entire strategy has to change. The focus often shifts from short-term timing to long-term growth and preservation over decades. Instead of just timing the market, they focus on owning great businesses and assets. Diversification becomes key. While a retail trader might go all in, many billionaires spread their wealth across asset classes: public stocks, private equity, real estate, venture capital, to build a resilient portfolio. Of course, some do remain highly concentrated in the company that made them their fortune, but diversification is a common wealth preservation strategy. At this level, trading individual stocks is just one small part of a much larger machine. The game is less about being right on a single idea and more about building a financial fortress that can withstand market cycles and last for generations. The psychology shifts again, from the process-driven discipline of a fund manager to the patient, detached oversight of a dynasty builder. So, the journey from a retail trader to a billionaire investor isn't about collecting more secret strategies. It's an evolution of mindset. The retail trader is often trapped in a game of emotion, reacting to price, and fighting their own psychology. The hedge fund trader escapes this by playing a game of process, using discipline, structure, and statistics to build a consistent edge. And the billionaire investor plays a different game entirely, a game of scale, where the biggest challenges are deploying capital and preserving wealth for the long haul. Here's the most powerful thing to remember. You don't need $1 billion to start thinking like a professional. You can start today by shifting your focus from chasing price to building a process. Define your rules. Manage your risk like a business owner. Journal your decisions and your emotions. Stop trying to outsmart the market on every single trade and start building a system that gives you a statistical edge over time. That is the fundamental shift used by the world's most disciplined operators, and it's the first real step on the path from being a retail gambler to becoming a disciplined trader. Master the process, and the outcomes will take care of themselves.